unsurprisingly, our topic for this third session has been touched upon all over the place in the first two sessions. But this session really zooms in on the role of investors in the financial sector. And to understand the issues they face, it's always been clear that, of course, to fund all these absolutely ambitious and long-term projects, the cost of investment needed is way too great for the official sector alone, and it shouldn't be paying alone, given the profit opportunities for the private sector too in these areas. So we need to take stock of the necessary balance, and we always speak about complementarity between public and private investment, but is that really the case? Are there not real tension? And what is the role of central bank in all of this? What is the role of both in terms of guidelines and in terms of funding? What do we all think of greenwashing, and where is it at now, especially given everything we've heard specifically from the EU? So in order to discuss all of these topics, we're going to have three fantastic speakers today in this third session. First, we're going to venture into official financing with Mr. Tanaka, and then we'll go into central banking with Mr. Sleijpen, and finally, private investment with Mrs. Mateos Lago. And I will introduce them in turn as they speak. So our first speaker, Mr. Josué Tanaka, was until last month the managing director responsible for climate action and operational strategy at the European Bank for Reconstruction and Development. So it's very, very fresh. And in fact, you are here with us, Mr. Tanaka, from having been the founding leader at EBRD on climate financing since 2006, covering the whole range of policy. And under your leadership, green finance has reached 46% of total EBRD investment in 2019. There's lots of figures that you will definitely give us. I think it's important to also stress that you've been at the EBRD at its creation for the last 30 years, coming from the World Bank. And seems to me now that you've come back full circle with us at Oxford, since you are now also visiting professor in practice at LSE's Grantham Research Center, so another place. But we're always very happy to welcome our LSE colleagues. And you had your PhD at MIT, yet another shore. So Mr. Tanaka, we're very much looking forward to hearing you on the official sector's approach to achieving adequate climate investment in Europe, and including this relative role of public and private sector, and what tensions might exist and how they might be reconciled. So the stage is to you.
Well, thank you very much. And thank you for the opportunity to cover this increasingly pressing topic for climate action, otherwise known as climate finance. And as you know, and we've heard it earlier today, it's a topic very much at the core of the upcoming COP26. Indeed, Ms. Chair, you've been very kind to mention background. Just to mention that indeed my background is very much on financing of projects. So over these 15 years that you mentioned, I think we financed about 2,000 climate mitigation and adaptation projects. And for EBRD, the total investment, it was about $42 billion, 2/3 of which in the private sector. So it's out of this background that I will talk to you. And to a certain extent, my plan was actually to try to give, a general map of financing sources to show also how they interact. I'm not sure I will insist too much of the tensions, but at least I will emphasize what the relative roles are. So I think that before moving into actually, describing the frame and the different sources, perhaps 4 observations. The first one is the one about costs and order of magnitude. This has been mentioned by previous speakers, but just to throw one number, that, for example, on the supply side of energy systems, the estimate of a low carbon transition is something like up to $3.8 trillion a year, right? So that's just to give notion. Annual adaptation costs are estimated by the Global Commission Adaptation at something around 180, 200 billion per year. So that's just, we need to start at least having some notion of numbers. The second observation is two words: scale. So scale is essentially what arises from these investment requirements, and urgency, right? Because if we think about the IPCC 1.5 degree report, okay, this is very much viewed right now as the critical decade ahead, right? Either we manage to curb the emissions curve, or we'll be in territory in which we will have to really think about carbon removal, as being the main method in the future. So if you take in terms of orders of magnitude, what's happening, if you look at Bloomberg New Energy Finance, for example, for clean energy investment, you see, okay, things have moved, right? They moved from around 60 billion in 2004 to around 350 billion a year between 14 and 18. But the IPCC estimate for that particular segment of transition financing, they estimate at a factor of 6 times that amount, to be built up to 2050. So that's scale and urgency. Then a third comment is also to mention the situation that we're in. In other words, still not yet post-pandemic, lots of impacts, discussions of green recovery, and therefore, how do we integrate the discussion we're having with the recovery and stimulus package discussion is a key element also going forward. What I'm trying to say is we cannot just look at climate in isolation of what's happening. And the fourth point, which may be a bit surprising, but that's the way it is we're talking here climate finance, but is there really a single definition of what that is? Not yet, really. Okay, so we are, I'm going to focus really on mitigation and adaptation, but with the understanding that you still have around different forms of definition. So now let's just look at what I would call the climate finance landscape, and that's very much broad brush. I'm not going to go into detail, and I'm very delighted that both Olaf and Isabelle are here because they will be able to provide you with a much deeper assessment of specific sources of finance or specific sources of policy action. So to be practical, this landscape, I'm going to divide a bit, like you mentioned, Kalypso, in public and private, and go very quickly through major sources of climate finance in public and private. So if you look at the public sources, there has already been today, in your conference, quite a lot of discussion about the role of governments, about the role of the EU, the role of national policies, national, public investment and budgets. I would add to that we ought to also think about subnational finance. There is an increasing expectation, in particular, on the role of cities in climate action, particularly in this kind of COVID and post-COVID environment. Cities are also very much viewed, as a vector for climate action. And from a financial point of view, they raise, in a way, some additional dimensions that need to be thought about. On public sources, not to repeat what other speakers have mentioned before, I would just mention one initiative that I think is very relevant, which is the Coalition of Finance Ministers for Climate Action. This is 52 countries exchanging experience and developing experience in terms of fiscal instruments, public investment, green budgeting, many of the topics that have been covered in the previous sessions today. The second one is a bit where I came from, multilateral development banks. I think the key point to be made there is really that multilateral development banks have been putting a very specific emphasis on growing their climate finance. which, every year now we publish based on a common methodology, the annual results, right? And if you look from 2015, which I take this date because it was in a way Paris Agreement, right, to 2019, our volume of investments in climate finance has increased by 65% from 25 to $41 billion. Obviously important to mention, this is focused on emerging markets and developing economies. I think on the role of multilateral banks, it's important to mention also it's not just about money, but it's also about policy support. It's also about capacity building with the countries, in the countries in which we work. Another subset, I think, of actors on the public side to be mentioned are DFIs, so-called development finance institutions. Examples can be, the French AFD, for example, or the German KfW. These institutions have put a very strong emphasis on climate action. AFD, for example, was the first to commit to 100% Paris-aligned activity and set a 50% target for annual finance to be in climate. Also to mention the IDFC, the International Development Finance Club, which are then 26 of these development banks in developing countries and emerging markets that have placed an emphasis on climate finance. And perhaps the fourth public source I would mention are the concessional climate funds, right? And there, what we are talking about are funds like the Green Climate Fund, the Global Environment Facility, or the Climate Investment Fund, which have played a very relevant role in supporting innovation and action in emerging and developing countries. So that's a very quick lightning tour through some of the public sources. If we move to the private sources, well, you can certainly look first at the specific project level at both commercial banks and private equity. Commercial banks mostly acting with loans, private equity mostly by definition working on equity. And also important to say, looking, I would say, for significant returns against the risks they're taking. Investment banks can also be mentioned. They are, in a way, intermediaries between investors and corporates and project developers, right, in underwriting, for example, bonds or equity. And as I mentioned, bonds, I think it is relevant because it has quite a lot of visibility these days in terms of climate finance, is the growth of the green bond markets and also its own diversification. You now have transition bonds, and the BRD even launched last year the first climate resilience bond. So in a way, specialized bonds, you define specific criteria and you fund against that. The growth of the green bond market, has been encouraging, rising from about 50 billion in 2015 to over 250 billion in 2019. But important to note, key drivers have remained, in a way, Europe and North America, right? You do have a significant Asia slice, but for other parts of the world, very limited coverage. So this element of, for example, green bonds is encouraging, but remember the orders of magnitude I mentioned at the beginning, when we are talking about trillions, versus billions, if we want to move to that kind of unit of account in financial terms, then, we need to move to asset managers and asset owners. And this is where Isabelle will, I'm sure, give a perspective from a very large, if not the largest asset manager in the world, to show, how climate, is reflected, going forward in their investment decisions. I think it's relevant also to note a number of initiatives like Climate Action 100, 545 investors, over $52 trillion of assets under management. So these are, getting to those numbers, the big question is, how do you channel that? And in particular, how do we see the role of these different sources in three different parts of the world? So I'll divide that in developed countries, emerging markets, and developing countries. In developed countries, I think the key challenge and the key opportunity is really the shift of the financial system, of the overall financial system, to become a major element in accelerating the flow of private finance towards climate. Lots of important initiatives happening here, and I think Olaf will certainly cover what NGFS is doing and this question of the role of central banks. I think we should mention the 3 R's of Mark Carney, the reporting, risk management, and returns. These are elements that are again intended to support a whole of system change, right? We can also mention TCFD. We can also mention, initiatives linked to increase disclosure, by companies and financial institutions on climate risk and management. Now, I think, this earlier today, there was also a coverage of the European Green Deal. I think that's very important because that is an example, if you want, of an initiative with the policies set and with the financing package, as was described by Mauro Petriccione earlier today. So the point there, though, I would just mention, because remember I mentioned to you my practical view of things, is that in spite of all these sources, there are still issues, practical issues, because, for example, in terms of asset managers or asset owners even more, the ticket size tends to be very large, right? And a lot of projects in climate are very small. Therefore, aggregation, for example, becomes something, that's very important. I think because of time, I'll go faster here on emerging markets and developing countries, but I think the key message to be given here is that, in my opinion, the role of public sources of finance increases as you move from developed to emerging and then to developing countries. The role of concessional funds also becomes absolutely critical to climate finance in developing countries. And there you have this whole discussion, for example, of blended finance instruments. And I think, in order, again, not to go beyond the time, that has been given, maybe just highlight 2 or 3 issues. I'm not sure there are tensions, but there are issues. One is climate finance has been very, very tilted to mitigation, right? If you look at overall numbers, probably something like 90% of climate finance today is going to mitigation versus adaptation. That's a problem, and we can talk about it if there are questions on this. The second point is mobilization. We talk about blended, we talk about mobilizing, and we talk about how public funds can optimize the mobilization of private sector, but quite frankly, we're not yet there. There are a lot of instruments, there are a lot of things that have been done, but they don't scale up anything close, to what's needed. And the final to close is really the role of policy. Because if you have clear policies, like, the previous session talked about carbon price, I mean, you would have a phenomenal, instrument to accelerate the mobilization of private sector. But that's my conclusion, back to my MIT days, Maximin, we're still trying to do the most that we can within the policy environment that we have. Thank you very much.
Thank you. Thank you very much, Mr. Tanaka, for raising the scale, but also the specific of the challenges when we do talk about complementarity between public and private. And indeed, you yourself mentioned that Mr. Sleijpen will be able to go into much greater detail on the specifics connected in particular to the role of central banks. Mr. Sleijpen, you are a member of the Dutch Central Bank and the executive director of monetary affairs at the bank, and therefore a member of the network of European central banks and the European Central Bank in issues of supervision and greening for financial system, the NGFS. And you came, of course, to the central banking from the sectors of insurance, of pension fund. So you already came with a huge experience in financing. And of course, you too are also have your academic hat since 2007. You're in the Endo chairs of the European Economic Policy at Maastricht. University and coming with a doctorate from Groningen University. So, Mr. Sleijpen, can you please address for us the state of the current debate on whether central banks should play a role and how in climate change? And also drawing on your earlier background in financial supervision, what are your views on how the private financial sector should be managing climate risks and investing in green bonds?
Thank you very much for your very kind words. I'm very happy to be with you this afternoon. And the topic of my introduction, indeed, is what can central banks do when it comes to stimulating investments in climate action. And indeed, I think 4 or 5 years ago, when somebody would try to link central banks with climate change, it was regarded something inconceivable. But that all changed, of course, with Mark Carney's very famous speech on the tragedy of the horizons. And about a little bit more than 3 years ago, the network on greening the financial system was established. A group of, at that time, 8 central banks who thought it would be good to share knowledge on climate change. And nowadays, a little bit more than 3 years later, we have more than 80 members in the NGFS. And one of the most recent additions, and we're very happy that also that central bank, let's say, came around the corner, is the US Federal Reserve System. And indeed, all 5 of the continents are represented in the NGFS. And today, I would in particular like to focus on the central banking, the role of central banks in fostering investments in sustainability. Because indeed, as we all know, getting the world economy sustainable for future generations requires huge investments. And a big part of these investments need to be made by the private sector. And for these private investments to scale up sufficiently, we need to get the right conditions in place. This is first and foremost a task of governments, but other stakeholders must play their role in the energy transition too, including the financial sector and central banks and supervisors. Central banks do not all have exactly the same mandate, but what they do all have in common is that it is their job to safeguard the stability of the financial system and to keep prices stable. And in quite a few cases, they also act as supervisor, ensuring that financial institutions remain safe and sound, and thereby contributing to a prosperous economy. And that is why climate change is and should also be a concern for central banks, because there is no doubt that climate change and also other environmental challenges, by the way, such as by biodiversity loss, I will say a few words about that later on, threaten the economy and the financial system on a global scale. And indeed, one could say that almost by implication, climate change falls squarely within the mandate of central banks. And indeed, it is even our obligation to address these concerns. As I said before, I would like to discuss today with you what central banks can do to help mobilize more sustainable finance. Where do they have a mandate to play an active role, and where do other players need to contribute? And I think I can best explain my views by starting with the factors that play a role in private investment decisions. And along the way, I will also touch on some things that are important, but which lie a little bit outside the realm of central banks. But as I continue, sure enough, central banks will enter the stage as well. Now, let's first look at private investment. And private investment in sustainable, carbon neutral projects still lags behind what we need for a timely energy transition. And why is that the case? In short, because many green projects still do not have a viable business case. In other words, the risks outweigh the returns. And when we look at the returns, we see they often lag behind because carbon and other harmful emissions are insufficiently priced. And that was one of the major topics in the previous session. And indeed, as a result, sustainable investments often still cannot compete with fossil fuel alternatives. And the average effective emission tax in most countries is often not high enough to present a viable business case for climate investments. And then there's the risk side. Green investment projects often bear a relatively high risk for various reasons. For one thing, green investments usually involve new activities, with startups employing new technologies. And it typically takes a long time to generate any returns, and it is often uncertain how cash flows will develop further down the road. And this uncertainty is not only due to the parameters of the projects themselves. Often it is also due to a lack of clarity on what government climate regulation will look like in the future and how that will shape consumer behavior and social acceptance. And then there is the question of what is green and what is not. It is unclear whether and by how much companies and investment projects actually contribute to lower carbon emissions. This not only applies to new projects and startups, it also concerns major investments needed to make existing carbon-intensive firms more sustainable. And that's partially because many companies do not disclose the information that investors need to make an informed decision. And if they do, their reports lack uniformity. And as a result, investors cannot compare between alternative projects. Climate reporting by companies is still in many cases voluntary, and different standards are applied. And all this uncertainty gives risk to risk premia for sustainable investment that are often higher than for conventional investment. Therefore, banks, institutional investors, and others are less willing to provide the necessary funding. And if you look at this overall picture, it is more or less clear what needs to happen. First of all, we need to increase the returns on green investments. And one policy instrument is absolutely key here, and that is to raise the effective price of carbon emissions. And that ball lies squarely in the court of governments, preferably on the European level and maybe even a global level. And the EU Green Deal contains ambitious plans for this, and it's crucial they're not watered down. This is the one thing that makes all the other things, you could say. And then as a next step, we need to reduce risk. And in order to realize this, first of all, it is key that government commits themselves to a clear and credible transition plan. A plan that provides answers to questions like what emission targets will be met and when, what actions are necessary to achieve these targets, what regulation is going to be implemented and when, and what investments will the government do itself. This gives investors more certainty about future returns, which enhances the business case. And now, central banks. What should they do? First, as independent economic advisors, they can help governments in making informed decisions and in garnering support for new policies. They can do this through research on the impact policy measures have on the economy and on climate, and also by showing what the impact will be if we delay action. And my experience at the Dutch Central Bank over the past few years has been that people listen to central banks if they stick to their mandates and produce high quality research that shows the impact of the policy choices we make as a society. Cooperation can make a big difference in this respect, and that is why central banks and experts from all disciplines, many of you participating today, should work together more. And this way we can further improve the quality of advice. In the Netherlands, we gained valuable experience in working closely, for instance, with the National Environmental Assessment Agency. And last year, we co-produced a report in which we assessed the financial risks associated with biodiversity loss. And the report generated a lot of publicity and political traction. And this was partly because of the combined warning issued by two research powerhouses. Second, what can central banks do? Now, in their supervisory role, central banks can push financial institutions to take climate change into account in the latter's risk management. More and more supervisors, like ourselves, require financial institutions under their supervision to adequately manage climate-related risks in their portfolios, just as they do with other relevant financial risks that they face. And for financial institutions to manage their risks and play their role in the transition, they must, however, have access to information regarding the impact of environmental challenges on a company. And they must also be aware of the impact of the company on the wider environment. And here it comes again, that the information that the financial sector uses is only as strong as the corporate disclosure it is built upon. And that is why the quantity, quality, and consistency of corporate reporting on sustainability-related information must improve. Credible and comparable information should be readily available for all market participants, shareholders, and other stakeholders. Third, next to providing research, pushing banks to improve their risk management, central banks can also play a catalyst role by taking climate risk on board in their own risk management. To start with, central banks might consider including carbon emissions disclosure as a requirement in asset purchase programs, and this would further promote transparency. But to do that, by the way, we need the help from credit rating agencies, for instance. Credit ratings need to better reflect climate-related exposures so that the market can properly identify and price these risks. Central banks could engage with them and incentivize rating agencies to better reflect climate change-related risks in their judgment. Then last, and definitely not least, central banks should incorporate the impact of climate change in their monetary policy decisions. And that's because climate change and its impact on the economy will impact price stability, which is at the heart of most central banks' mandate. And central banks often also have the responsibility to support the overall economy without prejudice to the primary objective of price stability. Indeed, how climate change should be incorporated in monetary policy making is currently under debate in the context of the monetary policy strategy review of the European Central Bank. Now, this afternoon, I've talked about how we can, and in particular also central banks, can facilitate and encourage private green investment. But let me make one disclaimer here. I may have left you with the impression that finance always follows the real economy, that if governments and central banks and other policymakers and standard setters provide all the right conditions, then funding for the green transition follows suit. Although I think this is largely true, it's not entirely how I see the role of the financial sector. Financial markets players need and should not wait for all the regulations and conditions and perfect data sets to be in place before they can have impact. They also have a social responsibility of their own to make sure that their business models support a sustainable economy. And it is indeed good that many financial institutions are very active in reducing their footprint. To them, I would say, keep up the good work and extend it where possible. And to the others, I say, let's not only talk the talk, but also walk the walk. Summing up, central banks in their various roles and capacities have a lot of leverage over the financial sector and the real economy. Leverage that they can put to use to facilitate the financial sector in funding the transition to a carbon neutral economy. However, central banks cannot do it alone, and their contribution, however substantial it is, can only be complementary to the major government policy measures that I mentioned earlier, like raising the effective price of carbon emissions, enforcing better disclosure, and providing a clear and credible transition plan. The EU Green Deal, if successful, will go a long way to putting these necessary measures in place. Governments, both EU and non-EU, also the UK, regulators, private investors, financial sector, climate experts, and also central banks all need to work together to overcome the policy and implementation challenges. Thank you very much.
Thank you very much, Mr. Sleijpen. Indeed, the challenge is huge and central banks are big. And you've outlined the range of possible intervention. Seems that to some extent still in their inception, since your biggest role, that of monetary policy making, beyond research, beyond nudging, is still very much in debate. How much might there be a risk of politicizing? But what does it even mean to politicize, monetary decision making? And this is an old debate, of course, that used to be related to employment. So we are the very core of your business. And indeed, to supplement our triangle here, because our conversation on this panel is very much one of seeking the ground of optimal collaboration between the three sectors that you represent. So it is very much appropriate to, last but not least, turn to Mrs. Mateos Lago. And your name was already invoked, totally not in vain, by Mr. Tanaka, since you yourself you're the managing director in one of the world's biggest asset manager as global head of Blackrock's official institutions group, and a member of the firm's geopolitical risk steering committee, having worked in the firm for since 2015, having shaped its macro investment more generally and sustainable investing before, and having really led, from what I understand, the thematic investment thought leadership momentum that we know from the firm, from Blackrock. Now, prior to joining Blackrock, well, we have the same alma mater, Isabelle, Sciences Po, and you went to Sciences Po and then ENA, and came to the across the channel to the University of Cambridge, the other place, and then went to the French Ministry of Finance and to the IMF. So it sounds to me like you've kind of seen it all from the national to the supranational level, from France to Britain to Washington, and all the way back. So I would like to turn to you now to certainly build on, in part, what our two colleagues have been talking about. Indeed, you just wrote a piece, an op-ed for the FT on the appropriate role of central banks. So it sounds like this is a topic you might want to comment on what Mr. Sleijpen just told us, as well as on the private sector's perspective, and how much and how far and how fast you can pursue the ESG investment goals, and whether you find that the standards that are either trying to nudge or constrain you are actually appropriate, effective in this story.
Thank you very much, Chair, for this very kind introduction. It's interesting that you mentioned this FT piece, because I actually wrote it in December 2019, so just over a year ago, arguing that doing something against climate change was fully part of central banks' mandate, or that there was a lot that they could do within their mandate. And I received a lot of hate mail for that piece, a lot of support, but also a lot of people who strenuously disagreed with that view. And now it seems the debate has moved on quite a lot. Not that there's a full consensus, but as you heard directly from a prominent central banker just now, there is a lot more agreement that there's quite a lot central banks can do within their mandate. So definitely things are moving in the right direction there. So let me just, yes, as you suggested, give a bit of a private sector perspective here, and I'll touch on three issues. First, what is the role of the financial sector in this? Second, how far along have we come, and are we on the right path? And third, what else needs to be done, particularly by the official sector, to further encourage and incentivize this involvement of the financial sector in the climate transition. So to begin, what's the role of the financial sector in this? Well, I would say it's potentially fundamental for all the reasons that we heard of, but it's also indirect and contingent. It's indirect because the financial sector by itself isn't a meaningful source of carbon emissions, particularly when we're all grounded and unable to get on planes all day long. But in that sense, financial sector itself, okay, we can get to zero emissions and, very, very easily. So that's not the issue. The issue is how can we have an impact on the rest of the economy? And that's around allocation of capital, efficient allocation of capital that takes into account risks as they arise. And that takes us to the contingent part. In order to do that, you need to be able to form a view of what are the risks that you're exposed to. And that's, frankly, until recently, been very difficult because essentially you had to form a view around what is the scenario that we're going to be dealing with. Are we going to see a lot of policy action that is going to cause a lot of transition risk in the form of tougher regulation, higher carbon price, and so forth? Or are we going to see very little policy action and be exposed primarily to physical risks, to the risk of floodings, to the risk of, an entire real estate portfolio becoming worthless, and that sort of thing? And these are very different risks. And so you could have all the supervisory agencies in the world telling their banks and their financial sector, you need to manage your exposures. If you couldn't form a proper view of what is the scenario, what is a reasonable range of scenarios that we need to prepare ourselves for, you basically couldn't manage risk. You couldn't allocate capital in a way that is fully aware of climate change. That is beginning to change a lot. And the other thing that's beginning to change very quickly, thanks in large part to the efforts of Mark Carney and others who founded the task force on financial climate risk disclosures, the TCFD that was mentioned before. We now are beginning to have much better and a lot more data from corporates, from all the capital users, the firms and others, about what risks they're exposed to because of climate change and what they're doing to manage it. So I by no means want to say everything is perfect. I fully subscribe to everything the two previous speakers have said in the sense that more needs to happen in this space, and I'll come back to that. But I think over the course of the last 12 to 18 months, we've seen really fundamental change in the ability for the financial sector to allocate capital in a way that is climate aware. And that is a game changer. So are we on the right path? I would say yes and no. Yes, in the sense that we've seen a big acceleration in 2020 of flows of capital into sustainable strategies. Roughly, it kind of depends depending on the type of sustainable strategy that you're talking about or the instruments, but roughly plus 80% in 2020. This despite obviously the pandemic, all the conditions that you're all familiar with, which frankly, when they hit, a lot of us were thinking, this is going to set us back, 3 years in terms of greening the financial system. Well, guess what? The opposite has happened. Because when the world is all upside down, I think there was a realization from a lot of asset owners that big change is going to be inevitable. And so we might as well get ready for it. So that was, big acceleration of the flows into sustainable strategy. And when we survey institutional investors across the globe, which we did just late last year, they expect to double their allocations to sustainable strategies over the course of the next 5 years. So, if we keep doubling the capital allocated to sustainable strategies every 5 years for the next few decades, I think we'll be fine. But obviously, we can't afford to slow down. So, what has changed to allow this to happen? I think one very important part has been the greater clarity of policy announcement, of policy commitments. Frankly, until middle of last year, yes, a lot of governments had made commitments under the Paris Treaty, but the US was getting out, and everybody knew that the commitments themselves were insufficient to contain global warming below 2 degrees. And they were just commitments. There wasn't a whole lot of concrete policies behind them. And so a lot of asset owners, certainly the asset managers, central banks, others were saying, well, it's not my role to do climate policy. I can't front run policy. And I don't know how serious this is. I think by now nobody can say that anymore. I mean, we've seen the transition we've seen in the US, we've seen, the European Union, China, Japan, Korea make very serious commitments to achieve net zero emissions by a precise date. So I think there's now much greater belief that policy action is coming, and that is going to have a very significant impact on asset prices. And one would be a fool, irrespective of convictions as a citizen, not to take them into account. The second big change has been really the explosion of data that facilitate the measurement of exposures to climate risk. Data released by companies themselves. They're not doing it, out of the goodness of their heart. They're doing it because they're under increasing pressure from regulators, but also from investors. There's now a coalition of asset owners representing 140 trillion, I think, in assets that are leaning very hard on the companies they invest in to disclose their climate risk exposures and their strategies for dealing with it. So, and this pressure is going to intensify. And then the other thing that has happened, which is, I would say, equally important, is that the case for investing in sustainable strategies has become much stronger. I think until, frankly, a year ago, a lot of people, when you were talking to them about sustainable investing, were saying, yeah, sure, I care about saving the planet and all that stuff. But as an investor or as a fiduciary, my job is to make the best risk-adjusted returns I can. It's not to save the planet. Can you persuade me that I'm not going to give up return by investing in sustainable strategies? And because all of this was new and the data was patchy, etc., you couldn't really make an ironclad case. But frankly, over the course of this year, now you might say it's only an additional year of data point, but it's so compelling, the outperformance of sustainable strategies through the different phases of the crisis. There's also been a sort of avalanche of research, really scrutinizing different aspects of this. And so even people who want to take a very hard-nosed, purely risk-return view of the case for sustainable investing increasingly have to say, yeah, that's right, that makes sense. Sustainable investing. And then when you ask, okay, how do I do it? Again, until not that long ago, the number of asset classes and investment strategies that were available were often not right. And one of the previous speakers mentioned this, either, you wanted big ticket stuff and there was only small ticket items, or everything was in equities. And so if you were a fixed income only investor, like a lot of insurers or central banks, there's nothing you can do. All that is changing. I mean, the market, the whole ecosystem has evolved dramatically. We as an asset manager, and frankly, all of our competitors have done the same, have created many more products that allow asset owners to invest in sustainable strategies without having to make other fundamental changes to the makeup of their portfolios. And so this this process is well in train, and frankly, if we remain on the same path, I think we'll be okay. So what needs to happen now from the official sector? I would say two things. First is the official sector as a regulator. I think, you know, the more pressure we can put on corporates or all the users of capital to disclose their risk exposures, the better. Obviously, the more standardization we can have, the better. And I would say definitely at global level rather than just European level. Global, I mean, capital markets are to a very large extent global. So more transparency, more disclosure, more standardization. Having said that, and I hear all the concerns around greenwashing and wouldn't it be so nice to have just one standard for what is a green fund or whatnot. I think it's also really important to recognize that this is a very dynamic ecosystem and also a very dynamic moment in this, you know, what we've called a tectonic shift towards greening the entire financial system. And so you don't want to rush too fast into adopting taxonomies or labels that are going to be out of date within a year, or that are going to stop the evolution of the system in the direction that you want. So there's a regulatory aspect, but then there's also, I think, an underplayed aspect, which is the official sector, public sector as a financial sector participants. Central banks, sovereign wealth funds are big asset owners, each in their own right. Central banks, you know, foreign exchange reserves are something around $12 trillion. Central banks' monetary policy portfolios are even larger than that. Sovereign wealth funds, depending on how you count, you know, between 10 and $15 trillion globally. It would be crazy for governments to take all these efforts to move their economy, to move their citizens, to move the private financial sector towards supporting and being aligned with zero emissions and not do it themselves. So I think it would be quite meaningful, both in terms of signaling, but also, frankly, in terms of following the flow of money, if those sovereign asset owners gave clearer signal and executed plans to green their balance sheets more so than we've seen. I'm not saying it's not happening. Some have been doing it for quite some time, and the Dutch central bank has been a trailblazer in that space. But you know, it's not yet mainstream, and I think if it were mainstream, that would be helpful. And then sovereigns are also big issuers of bonds. And so far, you know, the sovereign green bond market is still relatively nascent. I mean, financial markets have massively cheered the announcement, of course, the creation of the Next Generation Fund that Jean talked about in the previous session. The idea that, you know, 30% of that is going to be issued in the form of green bonds. It's going to quadruple the size of the European green bond market. So it's massive, and the market is starved for green bonds. So hopefully we're going to see more action also from sovereigns, not only in Europe, but frankly globally, because the market, you know, green bonds are like something like 4% of the global bond market. We need a lot more of that. So in conclusion, I would say, you know, all the problems that the two previous speakers have mentioned exist. There's no question at all, but I will take the glass half full perspective. I'm quite optimistic that we're on the right path. It's an acceleration path that's really kicked in last year, but if we stay on that trajectory, I think we'll get to the right place, because we're now really seeing a virtuous cycle between government commitments, the sort of spontaneous flow of capital, pressure on corporates to increase their disclosure. And we're going to get, you know, little by little to a stage where there's not going to be sustainable investing. It's going to be investing, which by necessity, and as a matter of course, will take into account climate change as it allocates itself. So let me pause here. Thank you.
Isabelle, thank you so much. And for this optimistic take, which in our global climate change discussions, we don't often have, but you're right, the times are changing.